Here we go. All right. Hello and welcome to the Gradulting Workshop Series. At today's workshop, we will address the topic of taxes for domestic students. Our goal is to take some of the pain out of doing your taxes. We're going to provide you with a lot of information, answer your questions, and share resources with you. So, my name is Debbie McCutsky, and I am the coordinator of services and programs for graduate student legal aid. I use she, her pronouns. This workshop is co-sponsored by our office as well as the graduate school. So the graduate school is represented today by Amanda Strausser, and Amanda is the assistant to Dean Fetter. So thanks for being here today, Amanda, and for helping out with this workshop. I should say that the graduate school is the sponsor of the TerpTax service. So if you like this service, you can thank the graduate school as well as the whole TerpTax team. So before I introduce our speaker, I have a few announcements. First of all, automatic closed captioning has been enabled for those who want to read along. We welcome your questions and comments, so we're using the chat. It is not a webinar. We've had to switch, so we're just using the chat. Let's see. Yep, Amanda, I got that. And let's see. Near the end of the workshop, we're going to post a link to a survey. We only ask 4 questions, so please take a minute or two to answer that. And finally, for everyone who registered for the workshop, whether you attended or not, we're going to send links to the survey, the slides, and the recording. We're going to try to do that this afternoon, but for sure it will happen tomorrow morning. So let's see. I get to introduce our speaker. And gosh, Sam, you've been with us for 5 years now, I think. So I'm really pleased to introduce our speaker. His name is Sam Handwerger. He is an adjunct professor at the Smith School of Business, and he is the awesome advisor for TerpTax. He works tirelessly during tax season to help students with taxes. And Sam, thank you so much for being here today and for your service to our students. Before you dive into your presentation, could you tell us a little bit about TerpTax?
Sure, thank you very much. TerpTax is a free service sponsored by the Smith School and the grad school, University of Maryland, you know that place. And what we do is we work under the guidance of the Internal Revenue Service for preparation of tax returns free for anybody who comes in meeting certain qualifications, which almost all of our students do, so that's not a problem. And we enjoy doing it because you give the Smith students real good practical experience for their future careers in preparing your tax return. They actually do the returns very well under supervision, and so even though it's sponsored by the IRS, we will try to reduce your taxes to the most minimal amount legally possible. We work Monday through Thursday from 6 to 9. We do have virtual sessions available, and you go to terptaxumd.org. That's terptaxumd.org. I'll have that URL at the end of today's session.
Thank you, Sam. If you want to go ahead and get started with your presentation, I'm going to be monitoring the chat and we'll feed in questions or sort of interrupt you as you go with any questions. So thank you very much.
Okay, thank you. I got to reboot from the switcheroo that we just did a few minutes ago, so I'm almost ready. 1 second, and we'll be rocking and rolling. You see my screen now where I'm fooling around here.
Yep, you see you typing in the URL. Perfect.
All right, perfect. All right, here we go. Thank you everybody for being here. One thing I would like to say is this is the order of the day. We have an introduction. We're going to talk about who has to file taxes, who is a dependent, education credits, a look at the forms, and some planning tips and some bits and pieces around each one of these items. Two things to say before we start. Number one, My presentation does not represent a client relationship with anybody here, so that takes care of my legal liability issues. This is for education purposes only. And when I get into some of the tax detail and your head starts spinning, don't blame me. I'm just the messenger of our US tax law, which is about more than 10,000 pages of law and probably hundreds of thousands of pages of regulation. All right, here we go. So let's talk about what the formula is of your individual income tax, just so you get an idea. When we talk about certain parts of your tax return, or we mention certain names or descriptions and definitions, you'll have an idea what we're talking about. The first thing is that first you'll put down on your tax return what your income is, if you have any income, and notice it's from whatever source derived. Don't want to get into all the academics, but it means what it says. Unless it's specifically excluded through exclusions that says it's not taxable, everything that increases your wealth, whether you're bartering or whether you're using cash or credit cards that increase your wealth, meaning money that comes to you, is taxable unless it's specifically excluded. This is worldwide, so it doesn't matter whether it's here in the US or elsewhere. All right, that's number one. Number two, after you derive what your gross income is that will be taxable, we have the taxable, so it's income from whatever source minus the exclusions, then we get a gross income. We then have certain deductions allowed by law, which are called deductions for adjusted gross income. That's the AGI, adjusted gross income. That reduces your taxable income, which is good. Deductions are good. And then we have further deductions from AGI. The definitions of this is just purely legal. We don't have to get too worried about it. The one word that I want you to concentrate on is deductions. Wherever you hear me talk about deductions, keep your ears tuned to that, because that's good. Deductions reduce your tax. And then we get, and the deductions from AGI will either be the greater of itemized deductions or the standard deduction. Here we can simplify a little bit what we're going to be doing, and that is most of you will only be using the standard deduction, which is still a deduction. You won't need to do the itemized deductions because you get the greater of the two choices, the greater of the two. And in most cases, for all of you, the standard deduction will be much higher than your itemized deductions would otherwise be. Eventually, we get to taxable income, and that's where it hits the road, as they say, because then you'll apply the tax rate. The tax rates are progressive in the United States, meaning they go higher and higher based on your income. So if your income is on the lower side, the tax rate could be as low as 0, depending on the amount of income you have. And that's the good news, is that you may not find that your tax is all that burdensome at this point. On the other hand, if you're paying a lot of tax, that could be a good thing. You're making a lot of income. The tax that you'll come up with will still not be what you have to pay yet, because you may have certain credits. That's one more word I want to emphasize. You may have certain credits against that tax that you've computed, which will reduce further the amount of tax that you owe. So it's only the net at the end of the forms that you use to formulate this formula, and that'll be the amount you actually either owe or you've had paid in already through withholding. So that's the basic formula. Just wanted you to know. All right, now we get to you all. Most of you are college students, so we're going to talk about what it is for you. Do you need to file a tax return? Well, if you have income, you do need to think about whether you have to file. So let's take a look at some of the details of how that's going to work out. It's going to depend on the amount of income and one other thing, whether you had taxes withheld. So let's take a look at what we mean by taxes withheld, because your income might be below the filing threshold. Your income might be below that, which means you owe no tax. If you don't have to file, you owe 0 tax. But if you had taxes withheld, you want to get that back. It's refundable. Yeah, that's right. So this is your W-2 that you might get from working a summer job or a school job or any job while you're going to school and helping pay for your education and your personal expenses. This W-2 is what you would get from your employer. You should have it by now. It was due out by the end of January. Sometimes it may be a little bit late. If you haven't received it, check with your employer or employers that you had and to get a copy of your W-2 filing. So this is the W-2, and it's in this box and this box that you're going to be wanting to see if taxes were withheld. The box here is the federal taxes, and these two boxes are for the state that you worked in, which probably would be the state of Maryland. What you're looking for is, even if the number for amount of income requiring you to file is below what you have in 2021, if you've got numbers here or down here, that's when you want to file in order to get that back. So that's a reason to be thinking that you might be filing taxes anyway, even if you're below the threshold. So let's go back and talk about what those thresholds are. If you are single and you earned more than $12,550, then you do have to file. And this is earned income, to be distinguished from unearned income. Unearned income we'll talk about in a second.
Sam,
yes.
Sam, we have a question about, the taxable or earned income. If I'm a graduate student and I have a stipend, would that increase my taxable income? Also, would tuition remission increase my taxable income?
So it all increases your taxable income if it's taxable. We're going to get to stipends later because many of the stipends will not be taxable. So it's going to be a separate topic today. Is that okay?
Perfect. Thank you, Sam.
Okay. Right now we're talking mostly about earned income, W-2s or working a job of some sort. If you're more than $12,550, you do have to file. This is the standard deduction, by the way, which is why you don't have to file unless you're above this amount. If you're above this amount, you do have to file because the standard deduction will not bring you to zero. It'll bring you to some sort of small amount of taxable income, depending on how much above that $12,550 you are. So you'd be required to file if you're above the $12,550, the standard deduction. It includes earned income from a job, and the $12,550 includes unearned income from investments, including unearned income from stipends, if it's taxable. And that's to be determined if taxable. We'll have to, when we get there, we'll see if any of your stipends or fellowships are taxable. So the threshold of the $12,550 includes all income and including the earned income. So if with the earned income and any other income you go above that $12,550, then you're going to have to file. But otherwise, the standard deduction will take care of you just fine. That probably dismisses half our audience. But stay tuned because we're not done yet. You do need to know whether your stipend is taxable, any portion of it. Also, you want to know whether you're eligible for any education credits. So all that's to come. Investments. What about investments? Oh, now we have a different story of why you may need to file. Investments, which include interest from a bank, that you receive interest income, dividends from stocks or investments that you might have, and cryptocurrency trades. If you use cryptocurrency for purchasing things or you trade in cryptocurrency, there may be gains from that. And I hope that you're working with a decent cryptocurrency exchange agent where they're giving you the information of what your trades and use of the cryptocurrency have yielded in terms of gains and losses. To the extent that you have a net gain from all of your use of crypto during the year, that would be taxable. And unlike the $12,550, this is going to be taxable if it's greater than 1,100. So this includes all investments, all investment income. Let's get a little different color there. So this includes all investment income, including capital gains from stocks, interest from bank accounts, dividends from investments, or income from mutual funds, including cryptocurrency gains. So if all of that adds up to more than 1,100, then you do need to file as well. This goes into that calculation of the 12,550, but if by itself it is 1,100, then you'll have to file. So let's break this down just one more time. The first test would be, are you greater than 12,550? You'll need to file. Do you have taxes withheld? You'll want to file in order to get maybe any refunded amount. But one more reason to file, this is all or if your unearned income is greater than 1,100, you'll also need to file. Then we're going to have one more, we'll see a slide on it. If your earnings from non-W-2 work, meaning if you're an independent contractor, goes above $400, you'll also need to file. So let's just make sure we got the first three under our belts. This is the total amount of income from all sources. If you're above that, you have to file for sure. If you've had taxes withheld, you'll want to file to make sure that you don't miss a refund. And if your portfolio or investment, we'll call this investment income, is greater than 1,100, you also have to file. You may not owe tax, but you do have to file. And if your self-employment income, SE, self-employment income is greater than 400, you're going to have to file. Now, what is self-employment income? So this you would know because you would have received a form before. When we talked about earnings from a job, you got a form W-2. This is a form 1099 NEC. If you received any of this type of form from one or more places, and it adds up to greater than 400, then you also need to file, and you're going to need to report this, quote, self-employment income. I want to stop here for a second and talk a little bit more about self-employment income. Many of you students go to summer interns or interns during the year, internships. And when you do that, sometimes the employer, excuse the rough drawing here, says to you, oh, you're going to be an independent contractor. And you'll say, what's that? And they'll say, well, we're going to just pay you whatever you earn, and we're not going to give you a W-2. We're not going to take taxes out. We're not going to treat you as an employee. That's a W-2. So we're not going to, and you may say, oh, that sounds great. You won't take taxes out. But as you now know from the formula, taxes are on all income from whatever source derived, including independent contractor work. And now you have a new issue where the amount of taxes that you might have to pay on this will be higher than if you were an employee. So it's potentially a higher amount of tax here as an independent contractor than as an employee. What I advise you to do, since this gets into a seminar we could spend an whole hour on, is what is the difference between independent contractor and employee for tax purposes. Rather than do that, what I would say to you is if you received forms 1099 NEC, if you did receive any of those, come visit me at TerpTax, make an appointment, tell the volunteer that you want to see me at the time when I have a chance to talk to me, and talk to me about these forms that you might have gotten to see whether or not you have to incur the extra tax that might occur on that kind of income. And if you had only been treated as an employee, we'll see if we can do anything about that. There are alternatives. I just want to point it out. Again, I know, like, I'm brushing the surface. It's 9 yards of how do you determine the difference between employee versus independent contractor. So you just have to trust me that you would need to talk to me separately and we could go through it. All right. Any questions on that, Amanda?
Yes, we do have a question, Sam.
Okay.
So the question is, I have a 1099 NEC from catering work.
Mm-hmm.
Can I deduct some amount for mileage that I had to drive to each event?
Yes. And the amount of deductions and the types of deductions that you may have that you can reduce that taxable income by is another textbook unto itself, which is why I think the appointment tax becomes important. But the answer to it is yes, indeed, you can.
That sounds great. So please make your free appointment at TerpTax if you have more questions about the 1099. If I have a small business, running some apps like Etsy or other platforms, what do my earnings qualify as?
It's somebody with their own business. They're an entrepreneur. That is this type of income, but you don't give yourself a form 1099 NEC. It's also considered self-employment income. That's what entrepreneurship is, or sole proprietorship is another word we use for it. But you are self-employed. You're your own boss.
Gotcha. Thank you, Sam. And I will continue to feed questions in during the presentation.
Thank you. Very good. All right, there's my great drawing. All right. If you have more questions about general stuff that we're talking about here, I like that word, general stuff. You go to the irs.gov and look up their tax information for students guide. Don't trust everything they say, but it is a pretty good guide. All right. This is the slide that says, don't forget about taxes withheld. You might have just a few dollars of taxable income and you say, oh, I'm way under the threshold. I don't have to file. Check that box on your W-2 if taxes were withheld. to get the refunds. All right, now we are into the phase of, do your parents claim you as a dependent? The concept of claiming you as a dependent doesn't have the tax effect that it used to have, where claiming you as a dependent meant reducing your parents' taxable income. Now it doesn't do that, but it does have everything to do with whether or not you're eligible for the education credit or your parents are eligible for the education credit. So let's say that one more time. Whether you are, quote, a dependent for tax purposes of your parents. I know most of you think, my parents don't take care of me anymore, I'm my own person, but there's a different definition for tax purposes other than what your emotions and your own lifestyle might be like. And that's what we're talking about here. Today, whether you're a dependent or not isn't that important for saving taxes for your parent in the sense of what it used to be, because it reduces their taxable income. It only applies to whether or not you're eligible for the education credit or they're eligible for the education credit. We're going to talk about that soon, but let's first find out if you are a dependent, again, for tax purposes. So up until age 19, meaning 18 and below, whether you like it or not, or whether you agree with it or not, for tax purposes, you are a dependent of your parents. If you're 19 or over, and you're a full-time student, as defined by one full load at one semester per year. Let me go through that again. A full-time student is defined by the tax law as one semester's worth of credits per year. You don't have to do it all in one semester, but if you take basically 12 credits during the course of the year, for tax purposes at this stage, you will be considered a full-time student and therefore will be a dependent if you're under the age of 24. So again, up to age 19, meaning through age 18, you're automatically dependent. If you enroll in college, a post-secondary accredited school, basically, in the United States, then you are automatically a dependent until you finish the age of 23, up until age 24. That's why many of you might say, well, I'm not that dependent on my parents, but for tax purposes, you'll be considered a dependent automatically. And between the age of from 19 up until 24, there's one more caveat, and that is after age 18, even if you are in school and you don't provide more than half of your own support, you're going to be a dependent of your parents. If you're in school full time between the age 19 up until 24, and you're providing for your own support more than half, which is a fairly complex calculation to figure out, but if you are, then you will be your own dependent and not the dependent of your parents. Most cases, even though the parents are paying for your education, doesn't qualify as support. If this is a big if your place of where you would go when you're not in school would be most likely home, the home that your parents keep, and that's where you would take your bags and go back there. Most of the time, you're going to find you're not providing for more than half your support, even if you're providing for your own tuition. So in most cases, you're going to find that even up until age 24, while you're in school, you're a dependent. All right, what if you're a part-time student by the definition of the college now we're talking about the particular school you go to. If you're a part-time student by the school that you go to, you're 19 or older, well, you might not be a dependent if you're working and making more than $4,300. Then you're not a dependent, you're your own taxpayer, you're a taxpayer anyway, but you're your own, you can claim yourself, so to speak. It doesn't really make much of a difference except for those education credits, which we're going to get to, but this is just to give you a basic idea of who's a dependent and who isn't. If you're not quite sure from this little presentation, don't worry, that's part of the process of determining whether you're a dependent or not. There is on irs.gov, there's a who's a dependent. You can click on who's a dependent. It'll walk you through questions. You can answer those questions and try to get a better idea of whether you're dependent or not. We're more than scratching the surface, but there's more to what I'm talking about today in that answer, because everybody's situation may be slightly different. And there are some exceptions to everything that I've said here. All right, now we're into the education credit part. If the parents can claim you as a dependent, this is where it makes a difference. They may be eligible to take the American Opportunity Credit for eligible college costs, which include tuition, books, and supplies. Notice it doesn't include room and board. So it includes all the costs to get your education to be what you know it to be, not the room and board and not the weekend spending or anything other than do with required expenditures to be a student and to go to class. Whatever is required for you to spend to go to class, that's included in eligible costs. There are two education credits. We're talking about the first one, which is the AOTC, the American Opportunity Tax Credit. This is the one for your first 4 years. Your first 4 years. You've graduated high school. You're in your first 4 years of college, whether you've taken a full load each year or not. You're registered for 4 years. Those 4 years is when you are eligible for this, the first credit, the American Opportunity Tax Credit, which happens to be a pretty decent credit because the amount that you're able to take off your taxes is fairly robust. It's 20% of the first $10,000 of tuition. So that's $2,000. And then it's 20% of the next $2,000. So that should be another, it should add another 500. Forget my math. With all the students watching today, my math is off. But the total amount of credit you're eligible for will be $500. And that is for your parents to take if they're paying tuition or if tuition is being paid, even if it's through loans, if tuition is being paid out of pocket in one way or the other, either borrowing the money or they're paying for it, then these amounts, the amount of tuition may qualify your parents for a tax break, depending on their income, which gets into another thing. Or if they're married, or if they're single, or if they're married filing separate, there's income limitations on the tax credit that's available, but it could be as much as $2,500. And of this amount, 40% could be refundable, even if they don't owe taxes. That's nice. So it could be $1,000 back, even if they don't owe taxes at your parents' level. This is if they claim you as a dependent. Any questions so far? This is 2,500. That's why. Okay, so it's 20% of the next 2,500.
Yeah. Excuse me, Sam. We do
Yes.
have a question.
Sure.
Is the AOTC applicable for graduate students, assuming that they file themselves and their parents don't?
The AOTC would not be applicable to graduate students unless somehow your first year or two of graduate education is after 2 years or 3 years of college. In other words, suppose you got into graduate school after just 3 years of undergrad school. Then the first year of graduate school will be your fourth year down there, and yeah, it would qualify for the AOTC. Let's leave it as in most cases, the grad school will not be eligible for this credit. However, it'll be eligible for what's called the lifetime credit, which we're getting to.
Okay, thank you, Sam.
I'm just realizing how complicated this is. It's a good thing there's tax software that helps take care of this. What you need to know is you need to know the basics. So you know what to be entering into the tax software and to have some good expectation of what it's supposed to look like when you're done. For example, if you did pay tuition, even by borrowing money, let's talk about this. Even if you borrowed money or your parents paid for college education, and you expect to be able to see them use the credit, or maybe if we see, we're going to talk about where you might be able to use the AOTC credit or the lifetime credit, you do your software work or somebody does it for you. And if you don't see a college education credit in the formula of your tax return, then you want to ask the question, what happened to my education credit? That's what it's all about. Now, one big thing. Let's erase the board here a second and just say one big thing. The credit is not available for using for your tuition any monies that are not taxable money. So in other words, if you're using money from a 529 plan that your grandparents or parents set up for you, that does not allow you to take the AOTC. So what we're going to do is we're going to mark the AOTC here, the credit. If you do this, no, for that amount of money used, that doesn't apply for the AOTC. for any monies used by the 529 plan. If you're using money from a scholarship, that's not taxable, and it won't be in most cases. If it's a scholarship that's non-taxable and you're using it for tuition, then the AOTC won't apply either. So it's only if you're borrowing money or using your own money or your parents are paying for it or your grandparents, whoever is paying your tuition, it's out of pocket, then the AOTC and the lifetime credit is available. So I just want to make, again, bold strokes on these things so you know whether or not it's something you even need to think about. All right, there's the amount for 2021 up to 2,500. And you must be enrolled at least half-time according to the school, pursuing a degree or other educational credential. So you have to be in some type of program in a college, which is leading to some type of credential. Could be an associate's degree, could be a certificate at a school that has a certificate in certain topics, or you're a degree candidate. Now, if you're not eligible to be claimed on your parents' return, then you may be able to take the credit yourself. So what you want to do is you want to find out, that's why you see the word, that's why you need to determine, are you a dependent automatically by the tax law on your parents' return? If you are, then they're the first choice to look at to see if they can take the tuition credit themselves. In the event that their income is too high, now this is important. Should I say that? This is important. If your parents' income is too high so that they don't get the education credit or they're limited, whatever they don't use for education credit, they can give to you. And they can say, here, you, do this on your tax return and see what happens. This will be very, very important if, even if you're dependent, they can say, we will not claim you as a dependent for the education credit. They can sort of disavow the dependency for the education credit if their income is too high and say, hey, you can take the tuition and put it on your return. This will work really well if you do have taxable income. If you don't have taxable income, so you have no tax, so we say first you have to have taxable income leading to some type of tax, then the credit is valuable to you because it'll reduce that tax either to zero or it'll reduce some portion of it. The refundable portion of the AOTC, which is again $1,000, if you have the full amount of credit, you get $1,000 back refundable, even if you don't owe tax, even if your parents don't owe tax. The refundable portion would not be eligible to you under these circumstances. So let's go through this one more time just to make sure you got it, because I don't want you to miss out on this opportunity if it might apply to you. Your parents, step one, your parents' income is too high. They're not able to get any of the AOTC. So they tell you, we will put on our return that we're not claiming you as a dependent for purposes of the education credit. They can do that. It's very easy to do. And now you can use the credit. It will only mean anything to you if you do have tax on your return. So if your income is low enough where with the standard deduction, you get to zero, and or even with your self-employment income, your own business, it comes out to a zero tax, let's say, then using the education credit won't mean anything to you. But if you have any tax whatsoever, then the education credit here could be valuable to you as it'll reduce that number. But the refundable portion that might be eligible to your parents, that $1,000, which is 40% of the 2,500, that doesn't happen to you in these circumstances, that you're not eligible for that. So that's, unfortunately, you have to say that won't happen to you. You can't get $1,000 back from the government, quote, a refund. That's what refundable credit means, meaning even if you don't owe the tax, they'll send you the money. That won't happen here. It can be happening for your parents, but not for you. Now, one last thing, and then I'll stop for questions on this, and then we'll go to the lifetime credit. Well, maybe we should do the lifetime credit first, but let me just stop 1 second and mention that in the event that you are not eligible to be a dependent of your parents because you're not, then the education credit, if you have it, if it's applied to you, then you go back to being able to say, the refundable portion belongs to me. So when is it that the refundable portion doesn't belong to you? It's when you can be claimed as a dependent on your parents' return, but they're saying, we're not using it, so we're not going to claim you as a dependent for purposes of the education credit. Now, if that wasn't complicated, I don't know what is, but there you go. Let's do the lifetime credit, and then we'll see if we have any questions. So if you're in graduate school, yay. Even if you're not attending school half-time, even if you're only taking one course, even if you're even not enrolled as a graduate student, but you're paying for education in a eligible institution, which is generally the colleges that you think of as eligible institutions, then you would be eligible for 20% with the maximum credit of $2,000 per tax return based on the amount of tuition you pay. This is not refundable. So in order to make use of this, you have to have some kind of tax. Let's give an illustration of what we mean by credits, which will help unravel maybe some of the confusion about the refundable portion of the AOTC. Let's just take a look at that for a second. Suppose you come up with a tax of $1,500 due. Now you're taking the credits. Remember, that comes after the tax is determined. Now you're taking the credits. Suppose you determine that you have a lifetime credit of $2,000. How? Well, you took $10,000 of tuition paid for grad school, and 20% of that is $2,000. So there you are. So you'll subtract that. What you'll get to is zero. You don't get to where it's $500 being refunded to you by the government. That doesn't happen. Let's talk about the AOTC credit the same way. This was the lifetime credit. We'll call it the life. Some people are in school for life. Now we'll talk about the AOTC credit. So let's see how that would work. If the $2,000 you see here is, let's make it the maximum. The maximum for the AOTC is $2,500. So let's do that. So you determine that you have a tax of $1,500, but now your maximum AOTC credit is $2,500. You're going to be left with $1,000 here. Well, you will be eligible to get that refunded to you, even though your tax has been already reduced to zero. This will get refunded to you as if it was free money. That's the difference between the lifetime learning credit and the AOTC. That's why we're concerned about making sure you don't miss this. All right, that's education credits. Any question on that?
We do have a question on that.
Okay.
First of all, someone asks, can you claim this for tuition remission or only if it's out of pocket?
Has to be out of pocket. Tuition remission is as if they gave you the money, so that won't apply.
Yeah, too bad.
Too bad.
That is
Too bad.
too bad.
Yeah.
So sad.
Yeah.
All right, next question is, does income phase out for the lifetime learning credit?
I believe so. Yeah, I believe so. There is a phase out, but it's pretty high. Pretty high.
All right. Oh, we've got one more. Okay, it's all right. Sorry if you already addressed this, but I was paid by a fellowship this year and was paid through the student account, not payroll. I only have a 1098-T that states dollar values for, and this is in quotations, payments received for qualified tuition and related expenses, and scholarships or grants. How do I determine my taxable income?
We're getting there. Just hold on. We're almost there. We're almost there.
Thank you, Sam.
All right, thank you. All right, we're moving forward. All right, that concludes. That was also about the credit itself. Both credits have income limits. That's the answer that I just confirming the answer I just gave. Both credits have income limits. They're fairly high, although your parents may be above those. All right, now we're getting to what tax forms you need. We already saw, whoops, oh, what is this? Okay, this is the story of my professional life. The simple forms keep getting longer and longer. All right. Form 1040 will be what you use to file your tax return, assuming that you are a citizen of the United States or you're a full-time resident, meaning you live here, you're not an international student, you're not F1, you're not J1 in your first 5 years here at the United States. You're going to use this form to file your taxes. Schedule C will be if you have that self-employed income or any income showing to you from 1099 NEC. You're going to want to look at those forms. That will also give you, by the way, all the types of deductions. Well, I wouldn't say all, but it'll give you a lot of ideas of what type of deductions you can take from that kind of income. So if you're self-employed and you're concerned about, someone asked about the auto, the travel, and what other kinds of expenses, just take a look at Schedule C online. Go do a Google of Form 1040 Schedule C and take a look at the types of deductions you're allowed. If you have this kind of income, take a look at the same thing. It's the same form. This is the W-2. We saw that before. Here is the 1099 NEC. This is the non-employee compensation that somebody might be paying to you. It is subject to Social Security tax ×2, which is why I say you might want to visit me if you're determining that this number is causing you some tax issues. Here is the 1098E, which is student loan interest. The student loan interest, which will show up in this box here, is a deduction eligible to you. And you want to, if you get this and you're paying the interest on your student loans, this can reduce your taxable income. So don't throw these out. Don't throw the 1098E out because it may be useful for your tax return. Take it to your software provider and see what happens when you input it. And now for the big story of the day, the 1098T for your tuition. I'm going to show you two boxes because it's really only two boxes that you need to be concerned about to determine whether you have any taxable income from scholarships or whether you don't. And it'll also help you determine whether you have any money eligible for the education credit, subject to a little asterisk, which I'll leave for this discussion as well, but there's a little asterisk there. The two boxes that you need to concern yourself about is box 1, which is the amount the school received for your tuition during the year. Now this is the 22 form, but it's the same thing for 21. So this is box 1 is the first thing you want to look at. How much tuition did the school receive? If this comes from non-taxable sources, like we talked about a 529 plan, or it comes from an IRA, an education IRA, which is a special type of IRA. If the money in box 1 is coming from a non-taxable source where it's being paid for you, we're not talking about scholarships right now, unless the scholarship comes from some source other than this school, which I'll clarify in a second. As long as the money paid in here is coming from you or borrowing money, this is your tuition that would be eligible for your education credit. It would be eligible for you. So if you want to know where do I get that number, that would be one way to get it from that box. Now, I did say that some of this money could be from scholarships. If the scholarships is not coming from the school, you also have to subtract it from this number. So if you have scholarships not from the school that's sending you this form, so we'll just say scholarships other, they would also have to be subtracted from the X marks the spot in order to determine how much tuition is eligible for the education credit. If it's all coming from one school, then this becomes easy, which is it's box 1, and there's the scholarships and grants. And what you're going to do is the following. In order to determine whether you have, all right, this is it. This is probably the most important part of the whole day. In order to determine whether you have any taxable scholarship or not, you want to take box 1 and subtract box 5. If you get a positive number, you don't have to worry. All the money of your scholarship went towards some type of eligible tuition payment, and you're good. No taxable income. On the other hand, if you get any kind of negative number, we'll put it like that, when you subtract box 5 from box 1, now you may have, most likely have, taxable scholarships. Here's the general rule. It's always good to understand the why. If you understand the why, then you can understand better what's going on. Taxable scholarships are basically scholarships that are paying for your room, board, personal expenditures. If your scholarship is paying for room, board, or any other types of personal expenditures, that's taxable to you. If the scholarship is only paying for tuition, none of it will be taxable. If it's only paying for tuition, books, and supplies required for the school, none of it is taxable. If your scholarship is for everything, including room and board, it's only the amount above the school expenses that is taxable. Now, I say taxable, that doesn't mean you'll have to pay tax, depending on the amount of money you have from other sources, because the standard deduction can still reduce the taxable scholarship you calculate to zero. And then you don't have to pay tax on it anyway. But you do need to understand that this would be that this formula is how you determine whether you have a taxable scholarship or not.
So Sam, we have a
Yes.
question from Charles here. So if tuition remission paid by the school is not number one, is the question?
It should show up here. It should be in there if they are. That's what they should do. It should be in box 1.
What happens if it's not? Should they contact payroll?
In other words, it should be in both boxes. The X they should equal. If they're giving you tuition remission, then it really should show up in both. Now, did they get the 1098T?
Charles did not specify. Charles, did you get a 1098T? Yes, yes. Oh, yes. Charles did.
And it wasn't in box 1?
We're waiting.
Charles, you can unmute yourself if it's easier.
Thank you, Debbie.
Yeah, sorry. I think it makes sense. So if it's in box 1 and 5, then it cancels out and you don't end up paying anything. Is that right?
That is correct. You got
Okay,
it.
thanks.
Okay.
I feel like I messed up my taxes my first 4 years in grad school.
Oh, boy. Oh, man.
Well, if you need help looking at that, please make an appointment, a free appointment at TerpTax.
Exactly.
Thank you, Charles. Sam, I have one question from earlier. It might be a little ahead, but it's related to someone working an assistantship. Is that okay for now, or would you like to wait?
A TA, like a TA assistantship in the school? Okay, and what's the question?
So we had a couple of these. Folks worked in, they were conducting their work in another state, but the university was paying them for their assistantship. Where do they report that income? Is it Maryland income? Is it my home state's income? What do I do? Because really I worked at home, but UMD paid me from UMD.
Great question. I can answer that very quickly. When
Thank you, Sam.
for that work, you should get a W-2. And when you get a W-2 from whoever the employer is, if you look down here in this box, they'll tell you what they did, how they reported that income, to what state. Oftentimes, there'll be reciprocity between states, and they'll report it to Maryland, in which case, then that's where you report it. Sometimes they'll report it to another state, and this will be your key. What they put there. If they don't put anything there, then you don't have to worry about state, but there'll be something there, I guarantee. Okay.
Yep.
All right.
And then
Couple more. Go ahead, Amanda.
okay, so the number you get from subtracting is what you enter in the 1040 confirming?
That would be your taxable portion of scholarships, correct? Now, yes, follow-up question to that?
Nope.
Okay, one thing I want to point out is it's nice to look at this formula when you only have one 1098T and you have no other scholarships and no other tuition paid to any other institution. Keep in mind that the formula needs to include all tuition paid to all schools that you might have gone to and all scholarships. So this formula works really great when it's only one school and that's the only source of your scholarship. But just keep in mind, the formula is all inclusive if it's not on this form.
Gotcha. And then Sam, if I have tuition remission, how do I check to see if I'm eligible for that education tax credit? I think I may have paid some out of pocket.
Oh, check with the school. They'll be able to help you with that.
Check back with UMD or wherever you got that.
Right.
remission.
Check back and tell them why you're asking. They'll be able to answer. They're really good. They're really good with that.
Sam, I know this is a bit different, but I want to make sure I get to Jane's question here. So I'm just going to back us up a little. If I run a small business and I have several apps, can I combine all of my expenses and income into that one Schedule C form, or do I need to get a separate form for each app?
You can do either one. Theoretically, you could do it either way. Whatever would work best for you.
Perfect. And then last, Sam, if I am selling off some clothes and some things around my house, do I report that?
If you're selling them for more than what you paid for,
Mhm.
theoretically, that's a gain, and theoretically, it's taxable. I don't know too many people. Shh, is this being recorded?
It is
I,
that,
you know where I'm going with that. So,
yes, use your
so-
discretion and judgment to make the
right.
best. Okay, we got you, Sam.
Okay.
Let me just pop at the bottom of the chat. I think we're all caught up. So please, thank you, Sam, if you could keep going.
All right.
Just let me hop in just a second, please. Sam, I just want to let you know it's 1:26. I don't know if you have any other commitments, or if you can continue to answer questions and finish up.
Since I'm very close to the end of my slide deck, I'm going to continue till I finish. I may go a little quickly, but we'll get through it easily enough, and then I'll have a few minutes maybe for Q&A.
Sounds great. Thank you so much.
Thank you for thinking of me that way. Okay, I do have a 2 o'clock class. Okay, here we go. Just some tax tips. If you did work, either W-2 or you're self-employed and you have taxable income from that, think about contributing to an IRA. Now, there's 2 types. I wrote down here the Roth IRA. That seems to be the most popular. There's also a deductible IRA. They stand for, what do they stand for anymore? They stand for retirement accounts, individual retirement accounts, IRA, individual retirement accounts. And they're a great way to start your savings. You can contribute up to $6,000 as a maximum for 2021, depending on the amount of income you earned. It's based on the amount of earned income you have. So if you earned 1,000, you can put away 1,000. If you earned 2,000, you can put away 2,000, and so forth. So I encourage you to take a look at that. The due date for making that contribution for 2021 is April 18th, 2022. So you might say, well, I didn't do one for 2021. You've got time to still do one and do it for 2021. Now, if you do a Roth, it doesn't reduce your taxable income, but it does have certain tax advantages going forward, because even though they're not tax deductible, the money grows without taxes being taken out. You can take it out tax-free, all of it, after age 59 and a half. I'm not here to tell you whether the Roth is the better one to go or the deductible one is the better IRA to do. I'm just letting you know, think about an individual retirement account if you have earned income and you have the ability to put some money away. The Roth IRA has some advantages where, and we'll just leave this on the slide, I won't go through this, where you can take the money out with penalty or without penalty, depending on whether you had it in there 5 years or more. And there's certain exceptions. So I'm going to just leave these 2 slides in there, go through those rules. You can find plenty of this information on the internet. But one of the advantages of the Roth IRA is it's not stuck there like a regular deductible IRA, which is why a lot of people are starting to move towards the Roth IRA because of these advantages in the event that you need the money back before you're age 59 and a half. All right, so that's all I want to say on that. The details are in the, how do they say that? The devil's in the details. All right, student loan interest we mentioned is tax deductible, so don't forget that. You can write it off up to $2,500 if you have that much in student loan interest. Open up a 529 plan. Tell your parents and grandparents to do this. It's a little late for your schooling now, but for yourself, when you're a parent or a grandparent, a 529 plan is a great way to save for college education, because the money grows tax-free, and if it's used for education, it comes out tax-free. So just one more thing to think about. Electronically file is another good thing to do because it keeps your information safe, and it'll get any refunds that you're due a lot faster than sending in print. So I think the word to the wise is don't do anything other than electronically file. Otherwise, you might be waiting for months and months for the IRS to return your phone call of your refund. So that's my advice. TerpTax is another part of the advice. There's the URL. And the final statement I think I want to make is when you start working, you'll want to continue to consider doing an IRA when you graduate, but also when you graduate or any type of job that you might have during school, look in with your payroll department to a 401k plan, which is the same idea as an IRA, only potentially better because there's often an employer match. So my comment here is to make sure that none of our graduates or people who are working while in school, I don't want you to miss the employer match, which may exist with a 401k plan. That means if you put in $1, so that's you, and if you put in $1, then maybe you get some tax-free money because your employer puts in $1 as well, making everybody happy. So that employer match may be a way of capturing some money that you could otherwise just be saying goodbye to if you're not aware of it. And that is that. Q&A time for a few minutes.
Okay, Sam, I'll give you the first one. So if I received an end of year bonus from my employer in the form of extra vacation days, is that considered income?
No, it's not. That's just it's a non-taxable employee benefit. Good for you. I want to mention one question that came in prior to today, one about medical expenses. Yes, medical expenses are deductible as they're part of the itemized deductions, but if your standard deduction, which is $12,550, is greater than your medical deductions or any other itemized deductions in total, you're always going to use that standard deduction. So I don't think too many in our audience are looking at standard deductions. If you own a home, that's and with a mortgage, that may be a different thing.
All right, here's a follow-up question to that. Can I somehow deduct eye care expenses like glasses and eye exams if I had to pay for them 100% out of pocket?
Again, I was addressing the same question. My guess is it's deductible, but my guess is that the standard deduction will overshadow that and you'll take the standard deduction anyway. So unless you had a lot of those dollars that you paid for that kind of thing, wouldn't worry about it.
Okay, thank you.
Here's a question about backup withholding by bank. That's going to create withheld taxes, which you want to put on your tax return to see if you can get that back. And then you really should go to the bank to find out why they're doing it, because it's an indication that they received a letter from the Internal Revenue Service telling them to do backup withholding. So you want to inquire as what happened, why have you been chosen? All right, we had one from Pennsylvania. They live in Maryland. That, again, is going to show up on your W-2. Maryland and Pennsylvania has reciprocity. So if you work in Pennsylvania but live in Maryland, you really shouldn't have Pennsylvania taxes taken out. They should do it for Maryland only.
Well, and here's another question about moving. Ian moved from DC to Maryland in May of 2020, but he didn't change tax withholding to Maryland. But he's going to work in DC. What are his next steps?
So one more time, he moved from Maryland to DC or back the other way?
Ian, do you mind unmuting yourself and clarifying your question?
Yeah, thank you. I was living and working in DC and I moved to Maryland.
Okay, and you're still having taxes taken out in DC?
Correct.
Okay, well, the good news is that it won't hurt you, but you'll have to file in DC and Maryland. You'll have to file in DC with zero for the year if it was zero income. If you lived in Maryland the whole year, you'll be filing a DC return showing zero income in DC, getting all that repaid. Then you'll have to show all the income as being taxable in Maryland. So if you're continuing to work there, talk to your employer, tell them to, please start withholding for Maryland. One great trivia question is who in the United States has reciprocity for taxes with everybody, and it's DC, Washington, DC, because everybody comes to work in Congress from all 50 states. So Jeopardy might have that one day. It might be important.
Okay, thank you.
Okay.
Okay, Sam, one last question. Let's say I was injured and I received money from a claim. Do I need to pay taxes on that claim?
So if it was a physical injury, in most cases with physical injuries, it's not taxable. There is a fine line between some types of mental, emotional results of an injury where some of it might be taxable, but most likely not. So I think that what you've described to me, I would say is most likely not taxable with a 99% assurance.
But again, if they have any questions or need any help, they can make an appointment free with TerpTax on campus and get their question answered.
Yes, they can make an appointment. They can, that's the best thing. Even if they're not going to use this to prepare their tax returns, it'd be best to make an appointment and just let whoever you're corresponding with, the volunteer who's going to take your case, know that, and that you want to speak to me at some point. Or we can through email, they can get you in touch with me and we can trade information that way.
Wonderful. Thank you, Sam. So they should reach out to free TerpTax to get an appointment, start that conversation, and they'll get connected with you to work out any of these tricky situations.
Exactly.
Well, thank you so much, Sam. I want to thank you and Debbie from the graduate school. It's been wonderful to work with you. Thanks so much for taking the time today, answering all the questions and helping with the presentation. It's really a pleasure. I'll turn it back over to Debbie.
All right. Well, yeah, I will echo the thanks. We are so lucky to have such a great resource in you, Sam. Appreciate you sharing your time. Thank you, Amanda, for helping with all the technical aspects of this, and to Cody, who's in the background. And it was great to see everybody here on YouTube today. Thanks for making the time for us. If you need to watch it again, we'll be sharing a link to the recording, to the slides, and don't forget about that survey. Please fill out the survey. And I will leave you with this. Register for the next workshop, which is next week. It will be March 1st. And the topic is help me understand my job contract before I sign it. And I hope you all have big, lucrative job contracts that you will bring to that workshop. So with that, I will bid everyone goodbye. Have a great week. And let us know, both the staff at Legal Aid and the staff at the graduate school, how we can help you. Bye.
Take care.